We're going to be having a very interesting discussion today. We're going to be sharing our experiences when it comes to the world of trading. I'm joined alongside my colleague Akshay Iyer, who's one of our senior advisors here at Sarwa. The goal of today is to share and learn, simply. We're not here to give advice or specific action points that you need to take when it comes to trading. The idea is for all of us to share and learn from each other about best practices. And we have three guests here today who are going to be sharing with you their experiences investing and trading over the many years that they've been participating in it. It goes without saying that there's many different ways and avenues to be able to grow your wealth, and we're going to be exploring that today. Some of those might be trading, some of it might be investing through passive investment structures, active investment structures. There's many different ways to approach it. Some people might say, I'm not into investing in capital markets. Maybe I'm into investing in real estate. So we'll try to unpack it today. But the main goal is to walk away today by having learned something. Okay? And the best way to learn is to share. So in addition to these individuals, these brave souls who we've twisted their arm to come and speak today, we also encourage you to share with each other. So there'll be a lot of audience participation today. There'll be a networking event towards the end of the presentation. That's what's on the agenda today. Now I just want to do a quick check on the acoustics. Everybody can hear me clearly, of course. So just by show of hands on this side of the room, can you please lift your left hand up? Nobody can hear me. Okay, there we go. So it's working. A little bit of a reverb. Maybe we can work on the reverb. It's a little bit of an echo there. Echo, echo, echo. Right hand side, right hand up, please. Thank you very much. So perfect. You can hear me. Now I want to be able to hear you. So if I can on this hand side, can I just hear you say, yeah, no. This side, please. Don't quit your day job, guys. Let's start. Now I know that your hands work, your vocal cords work. So definitely during the audience participation, would love to hear you guys have your questions ready. And let's get right into it. Okay? Thank you. So we have here today three individuals who to share with us their experiences when it comes to investing. We have George Robrick, who's here and joined us today, along with Harsh Agarwal, and we also have Anis Nasser. I'm going to give you the opportunity to tell us a little more about yourself, but there's also a few interesting things that I've discovered along this journey, getting ready for this event. George, my understanding is that you travel quite a bit, and you've traveled to well over 15 countries recently, whether it be for work or pleasure. Please let us know a little about yourself and your travels as well. Oh. Okay, thank you.
Yeah, should be fine. Yeah, so I'm George. I've been here in the region for 6 years. Yeah, a bit under 6 years. I work for Amazon AWS, the cloud services. Yeah, like Aman said, I've been traveling quite a bit. Not so much the last few years, but yeah, pretty much most of Europe, North America, South America, everywhere. And today I'm here to talk about how I've been investing. I've run into Sarwa, what I've been doing for the last 5-6 years, and before that, and that generally just give you an idea of my ideas on investing.
Amazing. Thank you for that, George. Harsh, you have quite a very active digital presence. Just to try to keep track of it, I saw that you have a lot of educational blogs on crypto, tech, and blogging itself, right?
True.
Please share with us a little more about you and about your blogging activity.
Sure. Hi everyone. I'm Harsh Agarwal, not the UK one. In UK, Harsh means happiness. In UK, it means the other way, harsh. So I started my career in 2008, where I started this blog called Shout Me Loud. It became one of the top blogs in India, and its purpose was to enable users to follow their passion and monetize it. And it did wonderful for many years. Then I started another website called CoinSutra, which talks about cryptocurrency and blockchain technology. And when I'm not blogging, I usually travel a lot. I'm one of the lucky one to be in Antarctica. And as my passion, I also am a certified scuba diver advanced level. So that's all about me.
How fitting with our stock sometimes going down under very many feet. So we know we have somebody who can save us. Excellent. Anis and I have known each other for a number of years. We used to work together. However, he decided to take a little bit of a detour and stop making wealth for others and started focusing on making wealth for himself. Mind if you're just giving us a bit of background on that?
Yeah, hi everybody. So born and raised in Dubai, studied in Canada, abroad, came back 2008. Spent about 10, 12 years in financial services, private equity, wealth management for the most part. That's where we met at HSBC. Most recently, I've turned to day trading. So I've got full-time day trading and short-term trading for the most part. Been doing that for about just over 2 years now. So very specific to short-term trading.
Amazing. Thank you very much for that, guys. Looks like we're going to have a lot of different approaches towards investing today. I'm going to sit down because I'm getting tired of standing. I want to start with the first question, and these are questions that we've kind of put together to give us a really good insight as to how you guys approach investing. So we know that you need to make our money work. That's one of the most important facets when it comes to finances. Otherwise, your purchasing power reduces, inflation eats away into your purchasing power, and the goals that you have in mind will just start to seem further and further away. So you need to do something to make money work. So, if I may ask, how do you make your money work?
Yeah, so honestly, most of it is just boring ETFs in Sarwa. And one of the reasons is I don't want to think about it, and I don't want to be actively making decisions on should I sell, should I buy. Part of it is just my own investments, but that's mostly just long-term investing and a little bit where you play around with it. Not so much actively trading, but for example, just some algorithmic trading. That's more, if it makes money, it's fine. If you lose it, then you've lost money, but nothing to lose your night's sleep about. Uh, that's mostly how I do it these days. Because primarily, you just want your money to do something, and unless you're actively, actually involved in that industry, then it's very hard to make the right decisions. I think personally.
Well, so if I heard you correctly, so you're more or less focused on long-term passive investing through the use of ETFs. What about the stock picking itself? Is that something you participate in as well?
So I used to do that when I was younger, but then I also realized it's a lot of work. The risk is significant because you don't have the amount of funds to actually properly spread your risk. And in general, I don't see it worth it. Even with the algorithmic trading, I just focus on ETFs, not on individual stocks, because of the amount of effort and the amount of risk that you run.
What about yourself, Harsh? How do you approach making your money work?
I started with something called goal-based investing, and I realized, like, money. I mean, of course, the goal is to make money, but money has to come into some use, and that's where I started putting a goal for whatever goal that I had. Like, I want a villa, I want whatever education for my child, whatever. I put a goal, and I started investing based on that, and I managed my risk also by doing that because I was not taking too much risk. That's how I started. Now, once I've achieved my goal, I always revise them. Like every 3 years, 4 years, I have to revise my goal to improve on that. So a big portion of my investment goes to mutual fund, debt fund to manage the risk. But those are investment. Now, other portion of my investment is in cryptocurrencies, and I believe cryptocurrencies are like tech product. Apart from let's say Bitcoin, which you can look at for long-term investment, a lot of them would pop in and pop out because they are just trying to find us a place in the market, right? And the challenge with the emerging technology is like they are trying to fit in the market, and somebody else will look at pick their product, build something at the top of it. So you can't be holding a product like a cryptocurrency for a really long time. So the idea is to you get in and get out. So what I do is like cryptocurrency is my risk, like high risk investment. The market investment, which I usually focus mostly on the blue chip companies and more safe investment. There I like play more safe. That's how I approach.
It's funny you mentioned about cryptocurrency being similar to a startup. That's the same way that someone else had described it to me when I first entered into the crypto space because I couldn't make heads or tails of it. I'm like, what is it? Is it a company? What's the product? What did they sell, etc. And I just couldn't wrap my head around it because I was used to the world of traditional stocks, investments, mutual funds, ETFs. But it's a really good way. But as you said, some will succeed and some will not, right? Now, Anis, you've also played around with cryptocurrencies in the past as well, too. So, I mean, give us a little bit of overview. How do you approach making your money work?
Sure. So for me, it's changed quite dramatically actually over the last years. So like I said, I spent 10 plus years in financial services, wealth management, which is traditionally longer term, mutual funds, ETFs more recently, buy and hold, right? 20-year horizon, etc. Or whether it's a specific goal, 5 years, 10 years, depending on what you're looking for. Since I've turned towards focusing on income generation rather than wealth, I've had to shorten my time horizon, meaning, you can invest for 20 years, but that's not going to pay your bills today. So my trading has come down to day trading, swing trading over a few days, weeks. And so we can get into specifics of the strategy later on, but crypto I've approached the same way. So again, very volatile. Some things pop, some things fail, but it's very short term. Definitely high risk. Tech is probably a good analogy, actually. So that's where I stand now. So basically, majority of my money is spent on my my main account, which is trading, day trading, and I have money aside sets for ETFs and so on, which is there's this allocation that's split across both.
So when you say day trading, so my understanding is the stock that you buy at the beginning of the day would likely not be within your portfolio by the end of the day. Is that a safe and accurate description of it, or am I simplifying it too much?
No, that's hence day trading. You're in and out within the same day. Swing trade would be anything that's held overnight for more than one day, basically.
So then walk me through this now. So it's Monday. Actually, let's start with which markets do you trade in?
U.S. equities.
So you're trading in the evening then, our evening here. And you approach, it's 6 o'clock in the evening, markets are about to open. How do you approach your first trade for the day?
So for me specifically, I day trade small cap companies, and I'm a short seller for the most part. So there's again, rather than going to specifics about the strategy, I look at gapping stocks. What that means is basically stocks that have had their price go up overnight. So things can go from $2 to $5 overnight because of some news, PR that comes out, and the stock jumps. So my strategy involves looking for those type of stocks an hour or two before the market opens, and then making a plan in terms of how am I going to short it. In terms of shorting, I'm betting on the price going down during the course of the day. And the execution is very subjective in terms of just watching the intraday price action. Some trades can take minutes, some can take hours. It's very much up to the market.
It sounds like you have to have this. Quite honest with you, just listening to that alone altogether, I don't know if you're smiling, George, because you probably feel the same way as I, but you don't feel this or you don't go through this experience when investing in ETFs, right?
No, so for ETFs, no, it's literally just put your money in and don't look at it. I did have that with Bitcoin in end of 2017. I think the price was up to 70,000 dirhams. I actually bought those in 2011 for 2012 for about $100 each, and just left them. And at some point, the price just goes up and up and up and up, and then suddenly you see the value dropping by $4,000, $5,000 overnight, and everyone starts talking about it. So at that point, you just make the decision, I'm going to sell out of this because I'm going to lose sleep. Imagine if overnight you lose half of your investment. So that's probably also why in day trading you're not going to keep things overnight.
Yeah, I mean, I would add, with the longer time horizon that you have, less active, less engaged you are in the system, right? So you can invest, whether it's through Sarwa or any other platform, and just let it go because you're not planning to sell it tomorrow or next week or the month after, right? You're planning to sell it in 5, 10, 20 years. So it's a lot less stressful, right? A lot less active.
Can we get another mic? It might be a little bit easier. they're gonna fight for it towards the end of this event.
Sorry, could you repeat the question?
No, I was going to ask the same way. It's like, how do you, what strategies do you take, for example? Because I've noticed that you've got a number of approaches. You've got your fixed income, you've got your mutual funds, you also played stocks a little bit, and crypto. So, I mean, that's a lot to manage. So, how do you tackle that?
Right. So from the traditional side, like the equity or the mutual fund, of course, they are long-term investment. And I'm mostly a value investor, fundamental investor, and I bring the same to the crypto. On the crypto, what I do, I apply the asset allocation, like keep a big chunk from the investing perspective in the blue chip, which is Bitcoin, Ethereum, PNB. And then I have like some mid cap, like Link. I mean, I will not go into detail of the name, but and then I have small cap. Now, small cap are somebody which could become multi-bagger, right? To keep a tap on that, I invest in them and I do trade in them because of the volatility. Like they give really good return in good time. Now, initially, I never used to do stop loss, which was a big mistake. Now, as I'm learning, as I'm growing in this industry, I started using stop loss, and it's been very good.
Okay.
lately.
Okay, amazing. Well, thanks for that. It's funny. We're going to be talking about risk management at some point in the presentation today. Now, for those who are a little more active as far as the approach when it comes to investing, I would imagine there's research that's a part of the journey itself. But even the same way when it comes to ETFs, there's over 17,000 ETFs available globally. So how do you decide which ETF you'd like to go ahead with?
Honestly, I just only use the ETFs for the major indexes.
Okay.
So the SP 500 and the bond ETFs.
Okay.
Simply because there's relatively little research to do. There's liquidity is significant, so you never have to worry about, okay, can I sell this? Can I not sell this? You don't have to worry about how an individual market is doing, and in general, the performance is going to be good enough for that kind of investing.
Okay. No fuss, no muss, no research required. Just take a passive approach. Invest in a tracker. Really, at the
No,
end of
but
the day.
even if you take a more active approach, then the advantage is that you only have to focus on the general market performance as opposed to an individual market or an individual industry.
Okay. Okay. What about yourself, Anis? And I quote, if I remember a few years ago, you mentioned this that you don't even know what the companies do when you're deciding what they're going to buy. And I'm gonna remind you. I remember everything. You had mentioned that, and I was shocked when you said it. You said, "I don't know what they do, but I'm buying it."
So
Please walk us through this.
Well, I short sell, so I short. I don't actually buy. But my trading, as I said, is very very short term. Can take minutes, 20 minutes, 30 minutes, a couple hours. Like we said, within a day. So from a research standpoint, I mean, you've got your fundamental research, which is what you're mentioning, which is company background, products, financials, etc., which is traditional wealth management. That's what you would preach, right? And then you've got technical analysis, which is looking at the price, actual behavior of the price stock. And so when you're looking at very, very short time horizons, minutes, hours, the fundamentals are very irrelevant. Because let's say I'm trading Tesla as a stock intraday over 20 minutes. It doesn't matter what they do or what product they have or who the management is or whether they're making revenue or not. What matters is that the price needs to move in my favor during that time that I'm in the trade. And a lot of time, like I said, I trade small caps, which are basically just micro, very small companies with markets cap under $300 million. So for the most part, they're biotechs, and they're just no-name companies, very small startup type companies who are listed on the Nasdaq. And really, it doesn't matter. I'm not planning to hold it for weeks and months. The longer time horizon you're going for, then the fundamentals become more important because you need the company to exist in 10 years' time for you to be able to sell their stock. So for me, like the fundamental research is very basic in terms of just looking at the company in terms of what their outstanding shares are, their float specifically, because what moves price intraday is just demand and supply, meaning how many shares there are and how much demand, how many buyers there are on that given day. And so as a short seller, you're looking for stocks for trades where the supply on the given day exceeds the demand for it. And so for me, it's research about how big the float is, how many shares are available, how much volume is being traded during the day, because that's your demand, and technical charts. That's basically it.
So there is research being done, but it's not on the company level. There's all the other variables, such as the volumes and which direction is the market going, candlestick charts, all that. That's where you spend your time and energy on the research, right? What about yourself? When you're exploring avenues, what's your first step as far as the research you'll conduct?
Right. So I understand that I bet on the industry or the market, right? I know that India, for example, as a market, like it has the major outlook that it would grow by 12% CAGR for the next 10, 12 years. So rather than picking like different mutual funds, I would actually buy the index fund and chill there. I do bet on sometime on the themes. For example, I feel semiconductor or the carbon neutral. These are the two themes which would play out really well in the longer period, maybe like for 5 or 7 years. So I would start building a position there via ETF. That's what I do in the terms of in the traditional market. And in the crypto, do deep dive. I read a lot of white papers. I do a background check of the people who are building it. Uh, and in the crypto, the biggest part, which not a lot of people look at, is the tokenomics. Like in the traditional market, we have the quarterly report, right? Like we can actually see how the company is growing. But in the cryptocurrency, there is nothing like that. But then there is something called tokenomics, where we know like how much tokens are going to be there, what will be their market cap, and all the tokens are out there, how the tokens will be emitted. So doing, and most important, what is the use of token? Can this product work without token, or they are just like just a money grab for somebody, right? So this kind of due diligence takes time, and like earlier it used to take 3-4 days. Now it takes about 8 to 10 hours, like in 3-4 days. So yeah, that's my usual approach. And sometime I also I forget to add, like I do something called grid bot trading. So there is a lot of volatility in crypto, right? Like they on the technical chart, they keep uh, bouncing in a range, right? So the grid bot is basically automated way of trading where you define a range, and the bot would automatically keep buying and selling. And often, like if you pick a good company like cryptocurrency, it works really well.
So it's very comprehensive, from what it sounds like in this case. You do full 360 research before you decide to go down that avenue. But so if we had to think of publications, like where do you read? Like white papers, you can look it up online, download it, you can read it. But what other sources are you reviewing?
So the very first, of course, the white paper. In the cryptocurrency world, there is something called Coin Market Cap, which is the most popular place to find all the data. Then there are, if it's a DeFi product, like decentralized finance product, then there are some platform like Token Terminal. There's one or two more where you can actually see the data, like who's the largest token holder, what is the distribution of token. Twitter is very good place to find the latest information, but you have to be very mindful because a lot of people actually try to sell their bag, and like they get emotionally involved with the product that they bought. Like, oh, this is going to moon, and of course, a lot of retail users burn their hands doing that. So, uh, yeah, and then some websites like Cointelegraph, CoinDesk, which publishes the news. There is one platform which I really like. It's called Mesari. Mesari, they publish a lot of research report. They have a team of analysts, so they publish the category or the industry wide research report, uh, and it's a premium tool. So that's what I use.
Misari, how do you spell it?
MESSARI.
Okay, I'm going to check it out after this event. I would love to turn to the audience a little bit, just to get a little bit of idea of how you guys go about researching. Any volunteers would like to share with us how you approach your investment decision? What research do you do? What websites do you go to? What magazines do you read? Do you have a fun uncle that you talk to about stock picks?
Uncle Eamon.
Anything you guys like to share? The hands aren't working again. Boy, I should do the test. Thank you. Yes. Thank you. Much appreciated. Any other? Yes, sir.
Well, I don't like really reuse it, but I stumbled across this thing called Quiver Quant, and what they do is basically consolidate a lot of insider trading reports. Essentially, if there's a U.S. senator that's buying a stock, they will sort of consolidate and report on it. There's that. I think they also track mutual funds that invest or what their holdings are, holdings, and essentially like publish it live every time they get a news on, okay, there's this entity or this company or these people have bought these and these stocks, or they've sort of sold off certain companies, and it's a interesting place to sort of just track. I've never really like invested based on the information, but I've just recently discovered it and I was like, oh, this is so cool. Yeah, essentially. Quiver Quant. Yeah.
Any other examples you'd like to share? No, no. That's okay. Thank you, guys.
I've actually got a good example.
Please.
And when you go home, pay attention to it. Probably the best indicator to how the economy is doing here is to look at the amount of advertisements for financial services you get per day or on the billboards. 3 months ago, nothing. Now, last month, everywhere, buy crypto this, buy that, coin that, invest in this trading platform. You literally see it going up and down based on how much spare money, how much assets there are in Dubai right now.
Cut back on marketing, guys. Just with your face.
Sorry, that could be a trap as well. There was a lot of marketing for FTX, and we know already how it ended up, right? So.
Oh, I'm not saying the advertisements themselves aren't good. I'm just saying it's a good indicator how much wealth is coming in or leaving the country.
Yeah, as long as we don't get emotional, yeah.
Speaking of emotional, so this part of the event is talking about risk and risk management, right? You probably have heard the term. There's no such thing as a free lunch. Could be used, when it comes to investing itself. So I wanted to ask each of you is how do you go about managing risk when it comes to making an investment decision for yourselves?
Get started?
Sure.
Huge part of day trading is risk management because of how active you are. There's so many opportunities for you to lose money, right? Long-term investing, you're sitting on it and you're fine. You're waiting for things to progress over the years. If you're taking multiple trades during the day, the standard advice is basically look at the position size, how big your actual positions are, and stop losses, which is what Harsh mentioned, right? Because what I discovered when I started trading short term is actually you need a change of mindset, unfortunately, from traditional wealth, which is it's coming. That the idea is you want to look to add into winning positions and cut your losers quickly, versus traditionally you're told that you want to, if the price goes down for something, it's a bargain, let me buy more of it. So you're kind of adding to a loser in that position in that case. With trading, that's the worst thing you can do because you're magnifying your losses. If something's going against you, you want to cut your losses quickly. Stop losses are the best way to go because it gets out of position immediately. Emotions, which we'll get to shortly, can really influence your trades, especially when the more decisions you have to make during the day. If it's one decision to buy a S&P 500 ETF and forget about it, you're not emotionally engaged. It's done. Whereas if you're buying and selling during the day multiple times, each decision takes effort, takes power, and you gradually get tired towards the end of the day. And it's very easy to let losers continue losing because you have hope. Hey, maybe it'll turn around. Maybe I'll break even. Maybe I'll this. And that's not always the case, especially in the short term. Things can just keep going down, and you go down 5%. You're like, I'll wait a bit longer. It'll come back. Doesn't come back up. You're down 10%. Now you're like, I'm whole. I'm just going to wait. And then you're down 20, and it can just spiral down. So I would say that the size of your position matters most because that dictates how big your loss is. Stop losses because you need to have a plan where to get out of the trade. So every trade you take, at least on the short-term side, needs to have an entry and an exit plan. Entry is where you're going to buy or short sell in my case, and exit where you're going to sell. Or sell for profit or sell for a loss, both sides, right? So yeah, that's it from my side.
Thanks for that. Appreciate it. Stop losses. Sounds like it's a very popular theme here altogether. What other mechanisms do you use to manage your
Right.
risk?
So yeah, that's the number one. You write the winner and cut the losses first. It's very important. Like in investing, in trading especially. In investing, of course, when you're investing, what I do is like I invest in the company that I understand. If I don't understand, I don't invest. And especially if I speak to a lot of people, especially like someone who comes up with an investment idea, like, oh, this is a great product. Like, if I don't understand the product or if the product is too complicated, I always stay away from that. That's one of my risk management. On the higher level, my risk management is asset allocation, right? Like, I know, like, okay, let's say 20% or 30% of my asset is in crypto, right? That's of course risky. Now in that, like, about 20% is in small cap, like, the one that can go away anytime. So maximum I could lose is 20%, right? Now, of course, since I'm a long-term investor in even in crypto in some of the companies, I don't sell them, like, even if they're going 30, 40. My experience has been, if you pick, let's say, 10 such companies and the small cap category, 8 or 7 of them will die, right? And they do. But those one or two, when they actually they become successful, make more money than what you have lost. So that's what I do. In the trade part, of course, stop loss is there. And one very important thing when you're investing in stocks or crypto, what my thing has been, I know what is the price point I want to get out at. I do look at the technical chart. I use TradingView for that. If I see like certain indicator that market is like on the weekly chart, if the market is too, like for example RSI, if the market is too overbought, that's the time for me to get out. I don't marry the bag. Like that's not my plan, right? I want to make money and get out. That's how I.
Marry the bag. Is that what I just heard? That's the first time I heard that. I'm going to use that. You said something that really stood out to me actually, because you said if you're looking at mid cap, 10 companies, probably 8 of them will fail, right? At some point, right? There was a webinar or seminar we had done a little while ago, and we shared a little factoid, which really surprised a lot of people. But if you look at the entirety of the S&P 500 from 1926 till 2016, I'm just going by memory right now, for every company that's ever been listed on the exchange, only 4% account for the outsized returns that you see. So when we look at the S&P 500 and we see, oh, well, the average return has been 10.4% per annum, only 4% of the companies that were ever listed on US exchanges are responsible for those returns. The remaining 96% either met the returns of treasury bills or had negative returns. So it really goes to show you how challenging it can be to pick and choose the right investments, which goes down the route of ETFs, for example, why they work so well. You talked about asset allocations. You talked about long term. I mean, you and I, we talk about this all the time as far as the benefits themselves, but there's also risk elements when it comes to investing in ETFs as well. Was there any you'd like to share?
I think for me personally, the key thing is diversifying. And whether you do long-term investment in ETFs or even if you're doing day trading, you're not going to put a 50% of all your cash for that day in one company because, I mean, it's probably what, 5%, 2%? So somewhere around that. And I mean, I work in tech, and tech, generally the large tech companies have RSUs. They give people shares as opposed to straight up salary for compensation. The amount of people that I've seen that just get greedy, they keep their shares and they expect their company to do 15% year over year, every year, year in, year out. I mean, for the people a bit older in the room, they probably remember Enron. Anyone Enron? No?
Does anybody remember Enron?
Yeah, somebody remember.
Liz in the back.
I mean, imagine you're working for Enron, you have a significant amount of shares, and then in 3 months, from the most valued company in the United States to literally being untradeable. And not only are you out of a job, you're now also out of money if you decide to keep those shares. So, yeah, diversifying, keeping things in different markets, or at the very least, keeping things in large enough ETFs that you're not going to be impacted by a single market or a single industry.
See, the approach of investing in ETFs that track different indices around the world, that by itself is globally diversified. And that's how you're managing a risk altogether, right? Because one market may be the winner one year and then another market might be, the loser for the most part. So you've got to balance out your risk by
Yeah.
globally diversifying.
Yeah, exactly. Partially that. So trackers that track an entire industry or that track an entire market, like the SP 500 trackers, you basically covered all the large cap in the United States, and you got the what's called a total world index, where you pretty much track what the entire world's doing.
Now, there's risk from a company performance perspective, but there's also inherent risk within ourselves. There was studies that were done. One of my favorite ones is by Morningstar, which is called Mind the Gap study. I don't know if you've come across this before, but the key headline was that investment returns are usually better than investor returns. But in a sense, what it means is that most investors tend to mess around, and react emotionally to, how their stock is performing and decide to exit, go back into the market, pause, whatever it might be. But had they just left their investment alone, the returns would have been greater, right? So emotions, that's probably our biggest weakness. Our strength as human beings, but our weakness when it comes to investing in the markets themselves. How do you manage emotions?
For me, one of the ways to not get emotionally involved into whatever you're trading, and yes, that's long term, is just pick a fixed date. It's just the first or the second of every month, whenever you want to invest things. Just pick that date, you buy whatever you were planning to buy, and don't decide, oh, but it's low, and maybe I want to wait a few days, and then it goes up again, or oh, I don't want to sell because it's already too low, so maybe it goes up. Just every first day of the month, every second day of the month, you do your investment, you buy things, and you already take that decision out of the equation.
And anybody want to take a stab on it? I mean,
Sure, yeah. I mean, for me, it's a daily struggle. Like I said, as a day trader, you're taking dozens of decisions every day, and there's emotions involved in every single one, even if you're aware of it or not. I don't know if anyone plays poker, but the two main drivers are fear and greed. So you've got cases where you have your specific strategy, you have your rules for when I'm going to buy, when I'm going to sell, and you wait for the setup, the strategy to appear on the chart. If you were a robot, you would execute exactly when you're supposed to execute the trade, buy exactly when you're meant to buy and when you're meant to sell. What happens is your emotions get in, you're either fearful, you're scared to buy because the stock's going down, you're like, I'm not sure if it'll go back up, so you hesitate, you miss the move, then you end up buying it late because, oh my God, I missed the move, and so you're either buying early or late. If you take a few losses early in the day, you get emotionally charged, you get frustrated, pissed off, and then you try to revenge trade, you try to make the money back. And then you take bigger positions and you're like, oh, if I take twice the size, I'll make twice the profits. But because you're emotionally, you're already off, you're taking a bad trade, double the size, you end up taking double the loss, and it can become a vicious cycle during the day. So it's very important to kind of take your temperature throughout the day, every 30 minutes, every hour, to see if you are calm and collected and objective about your trades versus being on tilt and just seeing red, not paying attention to anything that's happening.
It's about having a strategy, really, at the end of the day, and following that strategy. Emotions have no variable. There's no component that,
Ideally, but we're humans. That's the problem. That's why algorithmic trading, which is something I'm exploring now, is very interesting because you code the system, you code the strategy, and then you just let the computer execute. There's no emotions involved. So it's an interesting avenue that I'm looking into. But day trading, active, like discretionary trading, yeah, emotions are a part of it and need to be under control.
I just get a notification saying, hey, you bought this. Okay. You can't change it anymore.
Love it, love it. He sleeps very well at night.
Yeah, so fear and greed, right? Like those are the two most prominent emotion that drive us to do anything. And of course, if you're an investor or trader, you have to go through that journey to really experience it. It's easy to say, like, okay, I am a high risk taker, I'm a low risk taker. But the moment your investment, the principal amount is 50 or 60% down, it doesn't feel good. And when your investment is 2x or 3x up, and then you're thinking of buying like a Lamborghini or car or whatever, and then when your investment goes down, your life plan changes. So yes, managing your risk and managing your emotion is a journey, and you would go to there when you actually go through this. Yes, being in crypto, of course, the traditional market was easy, right? Like you pick the good ones, and it goes through cycle. The downside is limited, upside is you know how much it's gonna be. Crypto was bad, tricky, and I was experiencing it for the first time. Like so I realized when you're overly invested, that's where you can't sleep. Like there was time like I wake up in the night and check my, oh, what am I doing? Oh, I'm up 10% and I'm down 10%. So first thing I started doing, I started minimizing my I invest enough that doesn't let me sleep. But then that's not the solution. The one solution that worked for me was meditation. It really helped me cool down, see things from outside perspective. And I actually started going for this thing called vipassana. It's like a 10-day thing. Like you go, you don't talk, you meditate for 10 days. And I started doing this in 2016, and I've been doing this for 5 years. As a person, it helped me to make, look things from, I mean, don't get emotionally, sorry, as a person, it stopped me from being emotionally involved to my investment and stay on course with my target, with my goal. Because my purpose is to make money, right? Again, as I said, I don't want to buy all these stocks because they will change. So yeah, for me, that works the best.
Thank you for that, Harsh. There was a question or a comment in the back. Maybe actually, if we can give the mic.
But just like obviously the number one rule of investing is buy high and sell low. I think the idea of stop loss market orders it works well in a vacuum. One question that I have about it is that asset classes are highly correlated. So right now, as we see in the past 9 months, markets are trading sideways. So let's say the S&P's range down between 3,600 and 4,200. You have a stop loss order, then you're automatically going to always be buying at say 4,000, selling at 3,600, and rebuying at a higher price. How do you wrap your head around that, especially given the correlation between asset classes, where things tend to all go down at the same time and all go up, especially during down markets right now?
Look, I'll leave it open for you guys to answer. 'Cause you guys definitely
could
trade a lot more than I.
Could you clarify what you mean by buying at 4,200 and selling at 30? Like,
Obviously, like if you have a stop loss order, like it's off, like let's say you buy 4,000 today, and that's
sure.
it's like let's say 10% for it to sell at 10% below.
Yeah.
It's gonna sell at 3,600. The problem is like, it's always if the market's reached out like it is today, whereby it's just going sideways, not really like breaking through up or down, then you're always going to be end up buying when the market goes up and then selling when the market goes down.
Right.
It's almost like an automatic bias. So you just have no idea that
So my response would be that I mean it's also strategy specific. What you're trying to accomplish your time frame, because if you're trading, let's say over a few days or weeks versus months or years, your stops need to be adjusted accordingly. So in my case, I'm day trading. I have very tight stops, 20 cents, 30 cents, a dollar maybe. If you're trading the S&P 500 and you bought it since January, your stop should be below the lowest it's been in the last 6 months, for example. Or at least that's what I would recommend. That way you don't get chopped up, because you're talking about, yeah, it goes up, you buy, you're thinking it's going to go up, and then it pulls back a bit, you get stopped out, and then you get chopped in the noise. So you need a wider stop, basically. And if the stop makes your loss too big, you need to downsize your position. But it comes back to position management, right? So that would be my response there. Is you need wider stop, and your time horizon matters. I don't know enough about your strategy and what you're trying to do.
I'd like to add one thing. So you said like the market is already in the sideways, right? And you're buying at 4,000, selling at 3,600. So basically you're not following the trend. I mean, the idea is to follow the trend. So that is one, and of course, position sizing is the another big thing. But are you an investor or trader? Investor. Okay, so here is how I would probably look at it. Like, how much market is down from the top? Maybe like 30-40%. And how much down it can go from here? If I'm an investor, this is the time I would start buying more. If my SIP is probably whatever size is, I would increase my SIP ticket size and start buying more, because market is already cheap, discounted, right? Of course, the maximum pain is gone. probably it would last for another 1 year, 2 year. I don't know. But if you're a long-term investor, this is like discounted price. You should like rather start accumulating than doing a short-term, spin-off.
And what I think is also important here, and that goes back to the discussion you had earlier, is you have an entry point and you have a stop loss, but you're not taking profit. You don't have a strategy that says, okay, at this point I'm going to exit the market and take my profit, and then at some point reinvest the same amount or reinvest whatever I have plus the profit. If you're just going to keep it, then you're probably also not going to need a stop loss if you're just investing it.
Yeah,
I don't have a stop loss on S&P 500 ETFs because why would you?
exactly. That's why I was saying I don't know what your strategy is, but if you're investing for anything over a year, 2 years, then you don't need a stop loss because same logic. If anything, your market's down 30% now. Even if it goes down another 20%, dollar cost averaging is your way to go, right, Sarwa?
Any more questions, guys, before I move on? We're on to our last few topics we're going to cover. Sir? Well, here's the thing. Nobody has a crystal ball, really, at the end of the day. So you can feel free to share your predictions, but at the end of the day, they're just predictions at the end of the day.
There you go.
I mean, from the macro, there are a lot of few uncertainties. But I think again, as I said, like the market feels it's discounted. From an investor, I would start like if I have to get into the market, I'll do STP route rather than like investing lump sum. I would still space it out for the next 1 year because the next 6 months we don't know. There are lot of uncertainties. The China market is uncertain. The war is still happening, and I don't know how it will unfold. Recession is still like they say like recession is the bad part is gone, but we still don't know if they start increasing the rate hike, market could go further down. But as an investor in me, I would start accumulating, space it out for 1 year, 10 months, 12 months.
Thank you for that. I want to move on to the last few topics because I want to make sure we attack the food line and get the drinks. When people think of the best trades, in history, people think of George Soros, supposedly broke Bank of England, where he against the pound sterling, and he netted $1 billion, just by trading against the sterling or the Bank of England. You had another gentleman by the name of Paul Tudor who accurately predicted the 1987 market crash, and he shorted the market in which he made $100 million in a day. Spectacular numbers. John Paulson predicted the U.S. housing crisis, and in 2007 started taking a position against the market, and he was rewarded in 2009 to the tune of $4 billion. First question: who is George Soros here? Excellent. What would be your best trade that you've ever made?
I mean, I can give you a specific trade. Personally, I don't know if you guys remember GameStop from last year, right? Okay, everyone's seen it's on Netflix now. Everyone knows it, right? So there was another stock called AMC Theaters, that went together with GameStop, and they both had a run in, I think it was January 2021. And then AMC had a secondary run of 500% in like 2 weeks in June 2021. And everyone thought it was going to the moon, right? Because that was all the talk on social media. All of them were driven by social media. So AMC had gone up from, I think it was $6 to $44 in 2 weeks. And then what happened was stock went up and didn't tank. It went sideways for a while. And everyone on social media was super bullish. Everyone expected it to go to 60, 70, $80 following GameStop. What happened. Everyone thinks it's going to go to the moon. I took the opposite view and positioned myself short. Again, that's just my approach to trading. So I shorted that around $30, and with that type of behavior where the stock goes up, goes sideways, what happens it went sideways for a month, 2 months. That meant was there was a lot of accumulation. A lot of people were buying at that $30 to $40 range, expecting it to go higher. So as a short seller, you're expecting to break down, and the minute it breaks down, everyone bought there is in the red. And so that's the best case scenario for a short seller because they're all going to panic. Oh my God, it's not going to the moon. It's coming back to Earth. And it tanked, I think, 30-40% in a week. And so it was, pretty good trade.
You netted 30 to 40% within the week, right? Decent numbers. Stores, I know you more primarily focus on long-term investing, but you've played around, with the markets every now and then. Success stories.
Yeah, I think the biggest one I already mentioned it is being lucky and finding very early crypto for like Bitcoin for $100, buying it, seeing hey, it's funny, I put it somewhere on a hard disk and price does nothing, and then 3 years later, price goes up and up and up and up, and suddenly you have like a down payment for a house. Oh, okay.
You didn't buy pizza?
I did actually lose probably a decent chunk in just automated trading with Bitcoin because it was worthless anyway.
At the time when you had Bitcoin, did you think anything will be, coming out of this at all?
I did see it as an interesting technology, but nothing more than that. Which at that price, it was interesting to see how the technology worked.
Wow.
I did not actually see it as being able to reach the prices that it did now, but I'm pretty sure that at that point nobody did.
Yeah. There's a gentleman right now as we speak who's financed an excavation crew to try to find an old hard drive that was basically he threw out, and I think it contains like multi-millions of dollars of worth of
$27 million.
Thank you very much. $27 million. So it's pretty interesting how we used to perceive Bitcoin before and what it is today, right? How about yourself, Harsh? Anything that, till this day you brag to your friends and say, look, this is what I did?
Yeah, of course, Bitcoin is one of them. I could go on Bitcoin, but there is another one which I really liked. Like in 2017 or 17, yes, yeah, Binance was launched, and Binance, when they launched, they published their white paper about their tokenomics. Like this is the token that we'll be publishing. This is the use case of the token. This is how we will burn the token. And I looked at the tokenomics, and since I was following this industry quite closely because of the Coin Sutra, I saw the exchange. And I'm like, oh wow, this is an amazing product. Product is good. Token has a use case. The tokenomics is not inflated, like it's limited, and it's a deflationary token. I was like, okay, no brainer. So I got in there. I bought like bunch of it at $1. Right now that token is trading at about 300 odd dollar. It went till $600. So that was my best investment trade.
Not bad. What's the percentage? Have you ever sat back and just calculated the actual return just for fun?
No.
Was there not enough zeros there on the piece of paper?
I know, and it's just part of my big asset allocation. So as long as it's 3-4% of asset allocation, I'm okay.
You're buying coffee next time. Sorry.
What I also think, especially here in the region, to keep it a bit more in the traditional market, is real estate, because you are seeing right now is prices are high, yes, but I mean Dubai is still a growing market. You see people daily on a daily basis. They want to rent. I mean the amount of real estate agents that you get calls from. Hey, do you want to sell? No. Do you want to sell? No. Do you want to rent it out? No. I mean Dubai is growing, but you already start seeing that the popular areas it's full. It's starting to get full. It starts growing outside. So places that are popular, prices are going up. And I mean, rent honestly, if you don't want to bother too much with daily trading or actively being involved, getting rent from a property is probably not the worst investment.
Does upwards sometimes 6 to 9% yields, depending on where that asset is altogether. And it's funny, when people think of real estate in this region, they think it's overpriced. But have they seen other markets around the world? It's we're still getting a bargain relative to other major metropolitan centers around the world. I want to see in the audience anyone you want to share any interesting stock that you've purchased or investment that you've made that just blew your expectations and did really well. Yes. What is it at now, Meta? Actually, I stopped following. Actually, how much? One set. Not bad. Not too bad. Not too bad. Anyone else? Don't be shy. We promise we won't borrow money. Awesome. Well, look, I think success stories are great. It's something we can tell our friends at parties and get-togethers. But we also have, unfortunately, sometimes we get losses. We end up we have a strategy, we execute it flawlessly, but the market decides otherwise. So what would you say is the worst trade or worst investment decision you've ever made?
I'll start. So I thankfully haven't had a single big loss. I've been diligent about my stop losses and position management. But coming back to the emotions, which is something I hinted at earlier, I've had a couple days where just spiraled out of control. So it would start with one or two bad trades, which I expected to work, went against me, got flustered, frustrated, and tried to make the money back. And the next trades were double the size, less, sorry, not the best trades, bad positions, etc. And then you magnify the loss, and then you have double the loss. Okay, I'm going to make it back by taking my next trade, and you end up taking 20 trades, and I gave back, I think, a month's worth of trading in a day. It burned.
And I can imagine. Definitely a lesson you won't forget, right?
No.
That goes without saying, right? What about yourself, Stores, Harsh?
Probably the worst one is investing based on the idea that a triple leverage SP 500 and triple leverage long-term bonds, with the idea that if the stock market goes down, then generally bonds will go up because investors get out of the market and start getting long-term safe investments. And then COVID happens and the market goes down and interest rates go up. And I mean, you've probably seen this: the market goes down and bonds go down both at the same time. So suddenly you're 50% down on your investments.
That was an odd time.
every year.
I remember that was really unusual and very odd.
The only time that happened was in the 1980s because interest rates were 8-9%. It was just flat market.
Wow, wow.
Yeah, I have two actually, and there's a lot of takeaways for me personally, and I would like to give it to you guys as well. So first one, a friend of mine called me one day, and we used to discuss a lot of stocks, right? And he told me like, Harsh, Hind Copper. So it's a copper company in India. Okay, my friend who's a big copper industrialist, he had like worth $150,000 worth of in copper. I did not do due diligence, and we bought like big bag. 6 months, 8 months, stock was at loss. So lesson number one: don't listen to your friend always. It doesn't work. You because you might get in, but you might not be able to get out. That's the biggest thing which I've learned, because getting in is easy, getting out is the toughest part. So when you're investing based on other people recommendation, you should know what price you wanna get out or what stop loss you wanna cut your losses. The second one, this was very interesting. Okay, so metaverse, right? Metaverse was growing, and Facebook changed their name to Meta. So a friend of mine found this company called YGG. Now YGG was basically an index fund of all the metaverse project in the cryptocurrency world. And this guy was like, Harsh, I want to sell my house and buy whatever I could. Okay, and I was like, never invest based on people recommendations, especially from the first one. But here's two things which happened. Market was too up, and when you are actually making a lot of money, you end up making some silly decisions because you want to invest, put money to the risk, put money to some use. So rule number one: you can make more money by not losing the money. Don't invest if you don't understand one thing. Second, when the market is the hype cycle is up, for example, right now AI cycle is up, right? Everyone is talking about AI, and you would see a lot of companies come out and they will say like, hey, invest in this company, this is going to game changer. And you, of course, you've already missed the AI hype, and you'll be like, oh, let me buy this company. Let me tell you a very interesting story, right? Dot-com bubble, 2090, 2000, right? Every company, they changed their name, they added .com to their company name, and the price of those companies shoot overnight. And retail investor, because they already missed out on those company like Google, Amazon, this or not was not there, sorry. So but they started buying all this company, and what happened was a big .com crash. So avoid the hype cycle. Second, invest what you understand. Don't listen to your friends always.
Pets.com was one of the victims during the .com bubble, worth multi-billions just on the name alone. Pets.com. But I see a lot of parallels because I've learned a lesson from getting advice from friends. I predominantly do long-term investing. This is my bag. This is what I prefer. And it's worked for me very well. I take a more gold-based approach, and this is what's worked for me. I simply just don't have the time or inclination after work to focus on trading. I can't do what you do. It's really at the end of the day. Anytime I've ever purchased an individual stock, it was always on advice of a friend. And every time it's gone pear-shaped. One that comes to mind was COVID period. And this is at a point in time when oil prices dropped to lowest that they're, if you remember that, it was like almost close to not zero, but close to zero at the time. And there was an issue with supplying the oil barrels. So what was happening was all these oil barrels were basically being put onto ships. The ships were just circulating all throughout the ocean. So all these companies who were owners of these ships, all of a sudden the valuation was going through the door because they didn't have enough ships to carry all this oil. So a friend of mine does one of these. He said, look, you've put your money in. You're crazy. You have to follow it. Trust me, I've made X percentage. You've got to do it. I do it blindly. I just go ahead and do it. He didn't tell me when to exit. I still held on to the thing till about 2022, and I brought it up to him in a conversation. I'm like, no way. So when should I exit from this? And he just looked at me like, you're still in it? Got out 2 weeks ago. Like 2 weeks after I told you to buy it. I'm like, you didn't tell me. He goes, oh, sorry. Like, so these things happen. This in my personal experience, but a lot of lessons. There's no questions. A lot of lessons that you learn by not really taking it seriously when it comes to investing. But if we had to go back, your younger self, right, 15 years ago, 20 years ago, and you had to have a conversation with yourself, what would you tell yourself? Younger Harsh, younger Anise, younger George, from what you know today.
I'm pretty sure we're not allowed to say buy $10,000 worth of Microsoft or Apple or no, but besides those kind of
Well, you're giving advice to yourself, so technically,
besides those kind of obvious statements is yeah, just be aggressive in investing when you're young. Put aside that money and don't be afraid to just put it all in very aggressive investments. I mean, you don't have to do 40% bonds if you're 20 years old because worst case, what's going to happen? It's going to crash, and you still have time to recover those kind of things.
Amazing, thank you. Anise, Harsh,
Sure.
what would you tell your younger self?
From start earlier, start active trading. I wish I started this 10, 15 years ago. But from a short-term trading standpoint, patience and just waiting for the opportunities, because timing matters when you are a short-term trader. And when you're sitting at your desk every day for hours, you want to impose your expectations in the market. You want to make money. You're sitting there. I need to trade. I need to make money, and the market doesn't care what you want and what you want to do. So rather than trying to force trades and try and make money by forcing issues, just sit back and wait for your strategy, your setup that you execute for. So yeah, I did so many unnecessary trades, so much expectation coming into the market versus just let it come to me.
Well said.
Yeah, I think I would avoid fees, avoid the complicated products because there is the point is when I started my journey, right? I was making money because of my blog. I needed somewhere to invest, and whatever advice I was getting, and mis-selling happens in the financial industry. I'm sure you're aware of that, and so yeah, I was invested in lot of those investment which I can't get out. Like I committed for 10 year, 20 year. Those were really bad, and still hurts me because some of those investment I'm still doing. And another thing, the one I would probably tell him to understand the magic of compounding. That is the eighth wonder of the world, truly. And it not only applies in the financial sector; it also applies in the life. So as only 1 plus 1 is 11 in the longer period horizon.
Love it, love it. We actually had a slogan or a tagline that said 1 + 1 = 3 all throughout Jumeirah Road. So I really resonate with that.
What I also think is important when it comes to understanding the product or understanding the market is don't think you're smarter than the rest of the world, because I mean you see so many people that think they have a plan, or people in the casino, yeah, but I got a system. Ultimately, there are so many people that have much more time to actively time those markets, to actively be involved in those kind of trades. There's a good reason that most of the people that do like part-time day trading, they lose money on average.
Yeah, I mean, I would add to that decide what your goals are first of all, right? Coming back to what you're saying, because I have a friend who just asked me for advice about trading. Can you teach me how to trade? And I'm like, well, I need to understand what you want to do. He has a full-time job, so it's like you cannot do what I do because you don't have the time commitment. You don't have the time to sit at the computer for that many hours. How much knowledge you have, and how active do you want to be? Do you want to be researching everything in detail, or do you want a hands-off approach because you have a full-time job and you just want the money to work on the side? So decide how active and how involved you want to be, because the more frequent you trade, the more time it'll take out of your day, whether it's researching or watching the screens and so on. So.
It's child's play at the end of the day. It's real money is what we're dealing with. The hard-earned money you're going to work for and or taking risks on, and it deserves a respect. And you have to put in the effort. Really, at the end of the day.
Yeah, I think what's misleading to a lot of people is just because it's become so accessible. You can open accounts with a broker overnight without any restrictions, no background in finance or investing. Put your money in the account and trade. Start clicking on your phone, right? Okay. And everyone thinks they're a trader just doing that, and they don't realize that it's a profession like any other.
What was the trading platform? Was very very popular with younger people, like
Robinhood.
Robinhood, which I'm pretty sure we're finding Europe for having like the typical gambling elements, things in their app. So you click
gamification of it, right?
It's you click on a stock and it makes a sound like ching. You got profit. You get a notification. Hey, congratulations! You get like a free share of this company or that company.
Okay, an Instagram thing, they do that.
Exactly, the gamification of investing, and then people suddenly think because they can click on an app, they can buy a stock, and you make some short-term profit. It's actually a viable investing strategy.
Thank you, guys. Did they do great, guys? Amazing. Let's open it up to questions. You might have a few, right?
This may be a little personal, but what's your benchmark, and by how much are you sort of beating it every year, or like since inception, or since you began trading?
Benchmark is pretty much just the Standard World Index, and I'm probably not going to beat it because there's always cost involved. But as long as you stay like within 0.5% of that, then that's fine by me. For my personal investments, as long as it makes more than zero, then I'm fine with it, because like it's a hobby. It's not a thing that I have to live from.
For me, it's income. So I have my living expenses that I need to cover. Obviously, to share specifics, but it's month to month. So there are months where I outdo myself multiple times, and months where they're rare. So 2022 was a very difficult month for the markets, as you guys know. So for me, it's not percentage per annum or anything like that. It's more just I have a dollar amount that I need to hit, and if I do more, great. But that's sort of my approach.
Right. For the traditional market, my benchmark is to just go along how the market is growing. For cryptocurrencies investment, I look at minimum 10x, 10x return. That's my benchmark. If I don't get that, I feel bad.
Any other questions, people? Yeah. Give me a second. What did you say? Thank you. You too. Yeah. So if crypto is 10x for return, what would be the one for equities?
Depends. For certain companies, for example, I invested in a company called Fiverr on Cloudflare back in 2019 when the COVID happened, right? Like, and I was sure like these tech companies and especially the Cloudflare was an infrastructure company. I knew it could do really well. The problem with the Cloudflare was it was not a profit-making company, and it would not profit for 3 years, right? And the price that time was about $25. Now, after the around the COVID time, it went $125. That's 5x. Okay, that's a very good return, but I did not exit because the time horizon for a company like Cloudflare is my 10 years, 20 years. I don't think I'm going to sell this company for a really long time. How much is the return? Honestly, I don't know. So now in the cryptocurrency, the reason I said 10x because I'm not talking about Bitcoin, for example. I'm talking about the small cap. It poses a lot of risk, but since I do my due diligence and I do my research very well, I know like certain companies if they take off, 10x is the minimum I'm gonna get. So did I answer your question?
Yeah, but I have a follow-up question now. What goes into your due diligence process?
Right. So very first thing, I understand the industry. I actually use the product. I'm the end user. So if you give me 5 product, I can tell you this product is good, this product is not good. That's one. Then the fundamental research, right? What is the utility? What is this product doing? Who are the people behind it? Right? What is their roadmap? What is the kind of community they're building, and who are the people working on the product? Where is the company incorporated? What is the background of the founder? So that's one side of it. The other side is the tokenomics. Like what is the emission of tokens? For example, like in the stock market, right? If you have a concentrated token with the investor, right? It's bad. Oh no, in the stock it's actually different, right? If the investor have like 40-50% of the stocks, it's sometimes good and they're holding up. But in crypto, right, the value starts at zero. So if the founders they have a large portion of token, right, they would dump into the market. That is one. Second, if the distribution is even and how evenly the token is distributed, is it inflationary, deflationary? What is the overall market cap right now? And when all the token are released, what is the fully diluted market cap? So product, fundamental, tokenomics. These are my 3 biggest parameter. And of course, technical sometimes it helps. So my approach is the fundamental is like getting a report of a patient. Technical is to understand what market like how the patient is doing right now. That is how I keep a track of this. I was tracking a lot of companies. Now I narrow down to 10 to 15 companies. That's how I approach.
Thank you.
Great. Any other questions? Yeah, I think if we don't have any other questions, we can maybe move on to the next part. Yeah, all good? Perfect. Yeah. Yeah. Even first trade, I would say, any successful trades, anything like that. But yeah, thank you guys so much for obviously taking the time today. Please help yourself with some refreshments. If you do have any other questions, don't hesitate to reach out. We're more than happy to help.